Good afternoon. I think we're going to go ahead and get started. It's just a bit after 3:30. I'm Dana Knapp, and I'm the President and CEO of ArtsKC. I would like to welcome you to the long-awaited tax reform panel. And I want to thank you for your patience. As you know, we had to reschedule due to weather. ArtsKC is pleased to join forces with NP Connect to bring this amazing group of experts together to fortify our understanding of the new changes to the complex tax law. I would like to thank Mike House and Matthew Naylor and World War I Memorial Museum for hosting us in this wonderful facility. Anna Joy Walker from ArtsKC, Brandon Harlson from NP Connect, and Carrie Chopta from the World War I Memorial Museum for engineering the event.
Sure, thanks so much, Dana. Nonprofit Connect is so pleased to partner with ArtsKC. It's so important that we come together to help the nonprofit sector. And I think that the weather has just been kind of a symbol of what's happening. From the last time to be cold and icy to today being, 70 degrees out there. It's just as opposite of what's happening in public policy. So I think this is a true symbol of what's happening.
Thank you. Our goal today is to arm everyone with the facts about what changed due to the tax reform, how it impacts our daily business practice, who benefits from the tax reform, projected impact on charitable giving. We'll also discuss if donors will change their charitable giving trends, and if and how nonprofits should change their fundraising strategies. We do only have 90 minutes for this hefty topic and will be mindful of time, but we do want to encourage feedback throughout the presentation. So do not hesitate to let our roving mic-bearing staff know if you have questions. I do ask that you wait till they give you the mic so that everyone can benefit from your insight. Without further delay, I would like to briefly introduce our expert panelists. First up, Jeff Chapman, Assistant Vice President of the UMKC Foundation. Jeff has 25 years of experience in fundraising. He currently focuses his expertise on planned giving, annual giving, and corporate relations campus-wide. Before joining UMKC, in 2015, he raised funds for the Kansas Wesleyan, Kansas State University, and also has a background in marketing and sales in the private sector. Mike Engel, partner at BKD. Mike has more than 20 years of experience in providing tax services. He's currently tax leader for BKD's National Nonprofit Group and member of the National Healthcare Group. Mike's currently responsible for leading the growth and the development of tax services for healthcare, colleges, universities, and nonprofit organizations. Corey Ziegler, Vice President and Corporate Counsel for the Greater Kansas City Community Foundation. Corey currently manages the legal duties of the Community Foundation. She facilitates complex development and business transactions and supports strategic relationships with the professional advisory community. Before joining the Community Foundation, Corey was a practicing attorney at Hush Blackwell. Chris Hoyt, Professor of Law at the University of Missouri Kansas City School of Law. Chris currently teaches courses in the area of federal income tax taxation, tax-exempt organizations, and charitable gift planning. Previously, Chris practiced law at the firm of Spencer, Fain, Britt, and Brown. Chris is a frequent speaker at legal and educational programs and has agreed to serve as both presenter and also moderator for today's event. Please know that I only touched on the extensive accomplishments of our panelists, so you may review their bio on the handout that you received. Please join me in welcoming and thanking our esteemed panelists.
Thank you, Dana, for that great introduction. Please stay seated. Thank you so much. It's wonderful to be here, and we're going to try to tackle in 90 minutes these new tax rules, and we'll try to be a little simplistic, if that's okay with you. Will be some complicated stuff, but kind of building on the basics as we get along. It's wonderful to speak to arts organizations and other nonprofits in the area. I'm inspired that if we look at this new tax law and maybe think different. Apple Computer had this slogan, think different. That was their marketing program, that you never know how you're going to solve your problems. And the solution might come from someplace you never thought. When I was at the ballet many years ago with my 5-year-old son, it was Swan Lake. It was a beautiful ballet, and all the ballerinas were on the stage on tippy-toe. It was a beautiful sight. And then I felt a little tug on my sleeve. It was my 5-year-old son. And he said, why don't they hire taller ballerinas? You know, solves a problem, right? Just so you can solve problems just thinking a little bit different. So is everybody having a good time? Okay, because we're going to change that. And so let's start first with how these new tax act changes. And first, all of us are going to have lower tax rates. And right now, you have the marginal tax rates. That means for every $100 you earn, how much does the federal government take? And in 2017, these are married filing joint returns. If you're single, you have to adjust for this. How do you know if you're married? A man of letters about 100 years ago wrote, a man may be a fool and not know it, but not if he's married. Okay, so there's a difference. So anyhow, if your income is, let's say, between $19,000 and $77,000, for every $100 of income you get, you have to pay $15 to the IRS. If your income is between $77,000 and $156,000, you pay $25 to the IRS. Well, that's going down. And it's going down to 12%, 22%, and the like. What I find interesting is this 24% rate. In 2017, if your income was $300,000, the government took 33%. Now, if your income is $300,000, they only take 24%, which means for people with income about $150,000 to $300,000, their charitable gifts only save them 24% instead of 33%. So first of all, we have these lower tax rates. So second thing, you all know the corporate income tax went down. It went down from 35% to 21% if you have a business. And so much of the new deficits we're going to have of $1.4 billion, we're going to have these deficits, the corporations pay less income tax. Something that some of you will be affected by is if you're self-employed. That means you file Schedule C, or you're a partner in a partnership, or you're an owner of a limited liability company, or owner of an S-Corp. There's a 20% income tax deduction available to you. So again, if you get a paycheck, a W-2 form, this doesn't apply to you. But if, let's say you're an actor in Kansas City, and you make $50,000 a year, then you'll have to pay Social Security tax on $50,000. But on the back page of the Form 1040, you'll be entitled to take an income tax deduction of 20% of your self-employment income, so that the actor will only pay income tax on $40,000, though Social Security tax on all 50. This was a compromise to the last minute. It only applies, and there's complicated phase-outs. If your income's under $315,000 married, $157,000 single, there's phase-outs if your income's over that threshold. But that was a last-minute compromise to get this bill through the Senate, and I tend to think that if we have new tax laws in the future, this is the first one they're going to repeal, but this is in place for 2018. And there's very quickly a few other changes. The estate tax threshold. Last year, a person had to pay a estate tax if they died with over $5.6 million of wealth. This year, they doubled it. You don't pay estate tax unless you die with over $11 million worth of wealth. And on behalf of Jeff Chapman, myself, and all the other employees and staff at UMKC, we want to thank Congress, because we were having problems with that $5.6 million threshold. But with $11 million, we might not have to pay the estate tax anymore. The charitable deduction, the most you can deduct when you give to charity is up to 60% of your income, up from 50% if you give cash. And now these last two things are what affects the charitable deduction. I'm going to go quickly through it here, but we'll slow down in a second. They have doubled the standard deduction, but they've eliminated the deduction for personal exemptions and dependents. And then they eliminated most itemized deductions except home mortgage interest, charitable gifts, medical expenses, and up to $10,000 of state and local income taxes on property taxes. Now, I just read through that. What does it mean? Let's take a case study. Here we have a woman who's filing a tax return for last year. She's busy filing her tax return. It's due next Tuesday, April 17th. And what you do is you take all your income. It's called AGI, adjusted gross income, your wages, your interest, your dividends, your rents, your capital gains. That's your total income. And then you subtract from that two numbers. The first number you just subtract, assuming she rents an apartment, she doesn't have a house, she'll subtract what's called the standard deduction. It's $6,350. And then you get a tax deduction for yourself, a personal exemption, $4,000. So you take your income and you subtract about $10,000, and that produces the taxable income. And that's when she pays her tax rate of 15% or 25% and the like. Now, if she's married and has 2 children, she takes her married adjusted gross income and subtracts from it 2 numbers. The first is the standard deduction is $12,700. And then you get a tax deduction for yourself, your spouse, and each dependent. And so with 2 children, she deducts 4 personal exemptions of $4,000, a total of $16,000. And one thing I learned from my own IRS audit is you cannot take a tax deduction for your inner child. Okay, it's got to be a physical child. Who knew? No, I didn't know. But it has to be a physical child. So what's going to happen in 2018? They doubled the standard deduction, but they eliminated the deduction for your dependents and personal exemptions. So on 2018, same fact, she'll have a standard deduction of $12,000. So she'll actually get a higher deduction. But this married couple, they were deducting about $29,000. And now their standard deduction will only be $24,000. But Congress says, don't worry, we're going to give you a child tax credit that's higher. It used to be $1,000 per child, now it's $2,000 per child. But that's the tax simplicity we have right now. I still think of the words of Mark Twain, who wrote over 100 years ago. Mark Twain wrote, imagine that you are an idiot, and imagine that you are a member of Congress. Ah, but I repeat myself. But that was Mark Twain over 100 years ago. So let's now look at an individual who owns a house. And she pays $20,000 of state and local taxes. So when you see SALT in all capitals in the newspapers, it stands for state and local taxes. State of Missouri, state of Kansas. Jackson County, Johnson County, Cass County, Platte County, property tax and the like, Kansas City earnings tax. Add it all up, she pays $20,000 of that. And then she pays $5,000 of mortgage interest deduction, and she makes charitable gifts, and add it up any way you want. $4,000 mortgage, $1,000 charitable. Or she's paid off the home mortgage, and she gives $5,000 a year to charity. In that case, you don't take the standard deduction, you itemize. And so she will then itemize her $25,000 of itemized deductions, state and local taxes, mortgage interest, and charitable gifts. So she has roughly $29,000 deductions if she's single. If she's married, she'll itemize and not take the standard deduction, and she has about $41,000 worth of deductions. Now here's the big change that's affecting a lot of Americans. They doubled the standard deduction, but they eliminated the deduction for personal exemptions and dependents, and they eliminated most itemized deductions. You can deduct your home mortgage interest as long as the debt is, on the first $750,000 of debt. So if you have a $1 million mortgage, you only deduct 3/4 of it. You can deduct your charitable gifts, so that's still deductible. Medical expenses, very few people deduct it. It has to exceed 7.5% of your income. But the big change is your ability to deduct your Missouri, Kansas City, Jackson County property taxes and income taxes. You can only deduct $10,000 of these taxes. So in 2017, she deducts all $25,000. But if she's single in 2018, she'll only be able to deduct $10,000 of her state and local taxes. And then she'll deduct her $5,000 worth of mortgage interest. She'll therefore itemize with $15,000, going down from close to $30,000 in deductions down to $15,000. What if she's married? That's the tough part. Because if she's married, she'll still have the same limit of $10,000 of state and local taxes. She'll still have her $5,000 of mortgage interest and charitable gifts. But she's not going to itemize. She's going to take the standard deduction. And that's what's going to happen to me and to many of us in this room, is that we used to always get tax breaks for our charitable giving. But next year, we're going to take the standard deduction, and we won't be able to get tax breaks from our charitable gifts. So, who gets tax benefits from charitable gifts? Answer is donors who itemize. If you take the standard deduction, you don't get your tax breaks from your charitable gifts. What's the impact of these new tax changes? we predict that the number of returns that itemize will fall from 47 million returns to 19 million returns. And the number of tax returns where people actually deduct charitable gifts will fall from 36 million returns to 16 million returns. And so the question all of us are asking is, will those 20 million taxpayers who used to get tax savings from the charitable gift, will that change their behavior? That fewer people will itemize, then will lose the ability to take the charitable tax deduction. So that's what we're here for, is to share with you. This is kind of the big change that could affect your charitable donations. And what should you do? And first of all, as you talk to your donors, most donors give because they support your mission. Just tell your story. And just a quick show of hands, we can learn from each other here. How many people have had one donor, at least one donor, come up to you and say, I'm going to give less to you in 2018 than 2017 because of the tax changes? Anybody? One. Okay, two. All right, three, four. All right. But that's interesting. In other rooms, not a single hand went up, but I've had here 4 hands come up. Here's our little report, giving by high net worth clients. Now, high net worth means they're worth over $1 million. Their income is over $200,000. The average in the survey was $16 million of assets, but if you got one Warren Buffett in it, that's going to raise the averages. 91% gave to charities, 50% volunteered. Their average giving was 25 grand. The general public was 2 grand. Of this survey, they said that receiving tax benefits only motivated 18% of these people, down from 34%. But their main reason for giving was they believed in your mission. They believed that the gift could make a difference. They had personal satisfaction or fulfillment. And those people that volunteer at your organization are much more likely to donate to it. 84% of the ones who volunteered also made a financial gift. So if I'm just a tax geek, which I will be for a few minutes, the first thing is, don't forget the 11% who itemize their deductions. And so if people are giving you $5,000, $10,000, they're going to itemize. And they're probably going to still keep on that practice. It's just that they might not get as much tax savings as they used to on a certain percent of gift, and Corey Ziegler will talk about it. The second strategy people come up with is bunching your gifts. And I actually was in a car last week with a guy in Arkansas who says, all right, he's going to make his gifts. He made a big gifts in December 2017. He's not going to make any gifts in 2018. But in 2019, he's going to double up the gifts and say, all right, this is for last year, 2018. This is for 2019. Try to get to the threshold where he gets tax savings from his charitable gifts. That's kind of tough on a charity, so the easiest way to do it, and Corey Ziegler is going to talk about it, is a donor-advised fund. Is just make a big gift to a donor-advised fund, get your deduction levels way above that threshold, and then cut your checks to your charities from the donor-advised fund so the cash flow will be the same and won't be the kind of artificial every 3-year gift. But the last thing that all of us can do is for our donors over the age of 70 and a half, they should change their behavior and make all of their charitable gifts from their IRAs. And just an anecdotal story, and probably this is the same for you. As I was explaining these new laws to people last year, I said, well, you can have a donor-advised fund and fund it in 2017. We get the tax deduction, load up on it. But I looked at these guys. They were 4 men. And I said, but you're over the age of 70 and a half. And you can use your IRA for charitable gifts. And they said, really? I didn't know that. And we're all educating our donors on how they can use their IRAs. But in the past, if they could itemize their deductions because their state and local taxes were so high, they didn't bother using their IRAs. So for these people, today's April 11th, we contact them and they say, stop writing your checks the way you used to. Change your giving to be from your IRA because you're going to get tax savings from your IRA. You're not going to get tax savings from your charitable gifts. Because remember, what can you deduct? You can deduct 10,000 state and local taxes. You can deduct your mortgage interest. But your seniors have paid off the home mortgage, right? Only 1 out of 4 seniors pays a home mortgage. 3 out of 4 have paid it off. And then their standard deduction, if you're over the age of 65, isn't just $24,000. It's like $26,000 because you get this higher deduction if you're over the age of 65. So they have to give $16,000 a year to charity to get $1 worth of tax savings. So change the way you give and give from your IRA instead. because that's the way you're going to get tax savings. We call it Charitable IRA Rollover. So Charitable IRA Rollover will be the best way for donors over the age of 70.5 to make the charitable gifts. They can make their gifts from their IRAs without having taxable income. So just a quick wrap up on how do you use Charitable IRA Rollover. Basically, this is a permanent law, and I have a donor who has to take out from his IRA $10,000 this year. It's called a minimum required distribution, or RMD, required minimum distribution. He's got to take out 10,000 bucks. So he calls up the IRA administrator and says, I want you to do two things. I want you to cut a check to a charity for 4,000 bucks, and I want you to cut a check to me for 6. And footnote, I've talked to one large charity in the community. Their IRA gifts in the first quarter of 2018 are double what they were in 2017. That their donors are savvy to this, and they've kind of come up to this. So anyhow, okay, cut 2 checks. One's to the charity for $4,000, one's to the donor for $6,000. And so when you look at the Form 1040, on the line for IRA income, there's 2 boxes. And one box says total distributions, and the second box says taxable distributions. And so in the total distribution box, he'll say $10,000. And the IRS computer says, okay, it's okay, this person took out the minimum required distribution, 10,000 bucks. But on the taxable distribution line, this person puts down just $6,000, the check that went to him. And then he puts 3 letters next to it. QCD stands for Qualified Charitable Distribution. And that tells the IRS why this guy's not paying $10,000 or reporting all $10,000 of income. $4,000 went to a charity. And that's Charitable IRA Rollover. And so that's the best way to make the charitable gift. Now, you can't take an itemized charitable deduction for the 4,000 bucks. Your tax benefit is that he only reports 6,000 of income instead of 10. And that's usually going to be a better outcome than an itemized deduction. So to be eligible, you have to be over the age of 70.5. It's not enough to be retired. You can't be 68 or 69 and use this law. You have to be over the age of 70.5. The most you can use is up to $100,000 of per year from your IRAs. But the magic of this law is it does satisfy the minimum required distribution requirement. And therefore, this donor over the age of 70.5 actually gets $4,000 worth of income reduction by using the IRA compared to writing a normal check to the charity. So who wins? Well, anybody who does not itemize, people who takes the standard deduction. As we see, there's going to be 20 million more of them next year than there was this year. Other people who win are, as your income goes up, certain tax breaks go down. As your income goes up, Social Security benefits might be taxable. Medicare B premiums. If you want to hear a senior citizen complain, well, just sit next to one for a few minutes. But one thing they'll really complain about is how their Medicare B premiums go up once their income's over $85,000 single or $170,000 married joint. Well, if their IRA distributions are not taxable, if they can get that down there, then they won't have to pay so much Medicare B premiums. And if your income's over $200,000 single, $250,000 married joint, you pay a 3.8% surtax on your investment income. If you can get your income under 200 grand, you get that tax benefit. So there's 7 legal requirements for this to qualify. The first is the individual has to be over the age of 70.5. Second, this only applies to gifts from IRAs. If you've got a professor with a 403B, they can't use it. They've got to move some money into an IRA to do this. Third, there's a law that the check to the charity has to be made directly from the IRA. And all that's required is that the check is issued in the name of the charity. I get this question every year. I just got a check from my IRA. I'm going to deposit it today and write a check from my checking account. Does that qualify? No. We don't trace the source of funds. Instead, the check has to be issued from the IRA to the charity. Now, there are some IRAs that have IRA checkbooks. Dangerous things, where every check is a distribution from the IRA. But the names I've heard are Schwab, Merrill Lynch. I'm not sure. I haven't verified this. But there are things like IRA checkbooks. For this law, that's the best thing. Because for the senior citizen, every little gift of 50 bucks, 100 bucks should come from the IRA under this law. Now, in the past, and when I looked at the statistics of this one charity, this large charity in the Kansas City area, their median gift from IRAs is $4,000. And 1/4 of the checks they get from IRAs are under $1,000 bucks. but 3/4 of them are over $1,000 because to bother your IRA administrator to cut a check is kind of a pain. So with these IRA checkbooks, you can write these checks for $50 and $100, and that's the best way for the senior citizens to make all their charitable gifts from their IRAs if they have them. But otherwise, the IRA administrators are going to be bothered writing small checks with this new law. Every charity is eligible, except that the three are the most fun to the rich people. The first is a private grant-making foundation doesn't qualify. A donor-advised fund at the community foundation right now doesn't qualify to receive these IRA gifts. And then supporting organizations, the Friends of the Hospital, the Friends of the Art, if they're 509(a)(3), supporting orgs are not eligible. And a lot of hospital foundations have switched to out of 509(a)(3) to other statuses just so they can get the IRA gifts. I have 3 children. They're all born at a hospital, a local hospital in Kansas City. And when my first son was born, he looked just like me. But then the doctors turned him right side up, and you could see it was very, very, very different appearance. Yeah, I'm dying here, guys. Your jokes have to be better than mine. I think to tell you that. Has to qualify for a full charitable deduction. Nothing that reduces the tax benefit. No dinner banquets or things like that where it's not fully deductible. No charitable gift annuities. And then finally, you have to give that donor the letter that you say you received no goods or services. A good form is to say, we got your check from your IRA and you received no goods or services. Why is that better form? It's not legally required. You could just say, we got your gift, you got no goods or services. But sometimes these donors just give all their documents to their CPA. And the CPA doesn't know what was a gift from an IRA, what was not. If your thank you letter said, thank you for your gift from your IRA of $1,000, they know that they can use this tax treatment compared to the other treatment. Some technical rules. The first is that you can use IRAs to pay legally binding pledges. That's wonderful. And Corey Ziegler talked to us about donor-advised funds and pledges. On a joint return, you can use up to $200,000, but maximum $100,000 per spouse. So man and woman are married, and everything I say applies to same-gender marriage, but maximum 100 from his, maximum 100 from hers, not like 150 from hers and 50 from his to get this limit. No withholding taxes on these IRA gifts. And then the question I'm getting now is, my mom died, I'm 58, my mom was 88, and my mom was using her IRA to make charitable gifts. And so my question is, can I make charitable gifts from the IRA I inherited from my mother? And the answer from the IRS is if the beneficiary, which is the son, is over the age of 70.5, then he can. Then he can use the same law. But that son is just 58 years old. So if mom died and she named her brother or her sister as the beneficiary, and they're 75 or something like that, yeah, they can use inherited IRAs and make the gifts from those and get this favorable tax treatment. So to wrap up my portion of the program, dealing with taxes, don't forget your large donors. They're going to itemize anyway. You know, the Hellsbergs, the Blocks, and the like, they're still going to give. And so your large donors are going to continue to give, and they probably will not be that affected by this law. For those people who have a hard time making those kinds of gifts and don't give $5,000 or $10,000 a year, the idea of bunching your gifts into certain years to kind of exceed the limit, and Corey will show us how that works with donor-advised funds. And the third planning strategy is that all your donors over the age of 70.5 should stop writing checks and start using their IRAs, because my experience is most people don't use their IRAs, but that's the one tax-saving vehicle that's left. But the most important mission for you is to tell your story. Right? Keep your donors involved. The volunteers at the organization are more likely to give. And so we'll see, we're going to hear, time will tell, and will this tax law be around next year? Paul Ryan stepped down from the head of the House. There's some talk about, will the Democrats take over the Congress? And you know, will we go back to the old law and things like that? So time is going to tell how much this affects your charitable giving. But with this, I'd like to turn this over here to Mike Engel, who's going to tell you about some of the rules that affect your organization, especially like your treasurer and your tax return. Thank you.
Thank you. I guess let me start by emphasizing telling your story. I spend most of my days preparing 990s, which are the tax returns that exempt organizations prepare. And the 990 is a great way to brag about yourself, tell your story, talk about all the wonderful things that you're doing. It's a public document. A lot of times we don't know who's looking at your return. So use that to your advantage to brag about yourself and to tell your story. So I'll pick up with maybe some impact here to the new tax law, kind of pick it up where Chris left off, and that's charitable giving. The big question is, will charitable giving go down with the new tax law? There are some thoughts that perhaps it could, and there are some thoughts that it won't, because people give because they want to give. They don't give because of tax deductions. In the two areas that we're focusing on is the number of itemized taxpayers will go down significantly. And as you itemize, you give charitable contributions, you get a tax benefit for that. And if we decrease that substantially, what effect will that have? Will it have an effect? We don't know right now, but there are some people out there indicating that there will be perhaps a 7% drop in overall charitable giving, which I think equates to $20 billion a year. But again, we'll have to wait and see if that's truly the ultimate. Those are just truly guesses. Those are truly estimates. I think there's been huge increases in gifts in 17 with donor advised funds. So only time will tell. The other piece is the estate tax exemption. When it nearly doubles to $22 million for a couple, where a lot of individuals in their wills left a lot of money to exempt organizations because they didn't want to pay a state tax. So if you had $15 million in assets when you were passing away underneath the old tax law, you could exclude $11 million from tax roughly. That means $4 million you'd have to pay tax at I think 50% or $2 million. So very well likely that $4 million went to a charity if you didn't have heirs. So if it goes to $22 million, what happens to that $4 million? Right now we don't know. Will it go to heirs? Will it go to 501c3s? So part of this is really paying attention to your donors. Talk to your donors. Try to understand. Be proactive. Come up with some ideas to engage them to hopefully minimize that impact. And if you're budgeting, make sure that you watch for it. Watch your bottom line. It could very well have an effect, and it may not. It's just something that we all have to be mindful of. Mind going to the next slide for me? Thank you. The other area is really this excise tax on executive compensation. This predominantly is going to affect larger exempt organizations. There's really two pieces of this, and that is if you have executives that make more than $1 million, there will be an excise tax of 21% on the excess. So an example would be if you had an executive or an employee of an exempt organization who made $1.5 million during the year, that $500,000 excess would be taxed at 21%. So an additional approximately $100,000 of excise tax that has to be paid to the IRS. The other piece to this is what we call parachute payments. And that is looking at what we'll call separation payments, severance payments. There's lots of different terms that you use. But if an exempt organization provides separation payments to their employees, and that payment happens to exceed 3 times your average 5-year compensation, then there'll be an excise tax on that. I haven't talked to many exempt organizations that we're going to see 3 times severance payments that would trigger an excise tax. And on that separation payment, the overall compensation does not need to be more than $1 million. And so this predominantly is really going to affect the larger exempt organizations that pay compensation more than $1 million. And what's interesting about this, there's 2 provisions that we talked about. And this one particularly, the idea is this particular provision is to treat exempt organizations just like for-profits. And so if you are in a publicly traded company and you have compensations to an executive, those compensations are not deductible when you compute your taxable income. And if that's not deductible, then your corporate tax rate is 21%, you effectively pay tax on that. So in all the wisdom of everybody who drafted this tax law to treat exempt organizations on the same playing field as for-profit is kind of an oxymoron, but that's the general premise for this law, is the compensation over $1 million, and that is the threshold for publicly traded companies to be deductible. Anything above that, we effectively have to pay an excise tax on. Thanks, Chris. The other one is unrelated business income, and there's really two components here that we're going to focus on. One, if you do have unrelated business income, you get a flat corporate rate at 21%. That means the gradual rates go away, and for some of us, that means we're actually going to pay more tax because the rate is 15% for income from 0 to 50,000, but income underneath the old rules from 50,000 or higher, you pay 25, I think 30, 35%. So your rate went down. One of the things that's also in this particular area is underneath the old tax law, if you had several different activities of UBI, we could net those all together and then file a 990T, the net income we would pay tax on. So a typical example would be you would have activity A that may make $100,000. You have activity B that lost $50,000. We would put them together. We'd have taxable income of $50,000 when we pay tax on $50,000. Underneath the new tax law, we have this siloing or activity by activity type basis that the new tax law says activity A that makes $100,000 and activity B that loses $50,000. When we file that 990T, we are no longer able to put those together. And that effectively when we file the 990T, we will be paying tax on $100,000. And what happens is that loss that you had from activity B, it will carry forward, but can only be used to offset income that's generated from activity B.
Help me out. I'm a museum. How do I have unrelated business taxable income? I have a gift shop. Is that going to be unrelated, or is it related? How does that work?
So the unrelated business income rules get somewhat complicated, but the theory is when you're an exempt organization and you receive income, if it's related to your exempt purpose, you don't pay tax on it. If you have income that's not related to your exempt purpose, in theory, you're supposed to pay tax on it so that you don't have an unfair competitive edge from a for-profit. So not everything is black and white, and effectively, unrelated business income gets complicated, but an example would be if you had a museum and you sold maybe gift cards that had art on those gift cards that you were displaying in your museum, we could argue perhaps that furthered your exempt purpose because it's furthering your showing the art that you had. Now, if you sold gift cards of the Kansas City skyline, probably not related to your exempt purpose, and that postcard is going to be unrelated business income. Now, it gets very facts and specific, but that's a kind of a high-level example of unrelated business income.
Yeah, great.
Mind going to the next slide for me? So this area of the provision of the law is probably where I think most exempt organizations are going to be affected in some form or fashion. Again, this is the area in all the wisdom of the IRS to treat exempt organizations just like for-profit. And in this area, the IRS has basically said, exempt organizations, you will increase your unrelated business income by certain fringe benefits that you've incurred and you provided to your employees. So the example would be from a high level, underneath the old tax law, if you are a for-profit entity, for-profits could provide parking to their employees tax-free. And any of those costs that you incurred, you are able to take a tax deduction for in computing your taxable income. Underneath the new tax law, a for-profit employer can still provide that same parking to their employees tax-free, but underneath the new tax law, a for-profit employer can no longer take a deduction for the costs incurred paid to their employees. So if you can't take a deduction for that cost, you therefore inadvertently pay tax on it at the corporate level. So now let's get back to the exempt world with the new tax law. The question becomes, a lot of times, what costs do you have that you are incurring for your employees? And if you have that cost, if you literally looked at the code, you will have income or UBI for the cost of those employer-provided parking. Where we're struggling right now is because all we have is a tax law. How do you figure your cost? What are your costs? There are some theories out there that at the end of the day, all the IRS wants is tax on parking. So some employers who used to offer employee or parking to their employees tax-free are now taxing their employees on the parking. And that thought is, well, if I at least tax my employee, therefore the IRS is getting their cut of the taxes, therefore my exempt organization doesn't have UBI. So there's a lot of things going on out there, and really what we need from the IRS is guidance on on the employer-provided parking. But I do believe that this is the area I think will have the biggest impact on most exempt organizations, and I wouldn't be surprised if the number of 990Ts that are going to have to be filed to report UBI will increase. And there's lots of conversations out there that says, I have a surface lot, I don't pay anything. So where will I have UBI? The question is, well, you've got a parking lot. Do we need to take into consideration depreciation? When you bought your building, there's a parking lot attached to it. You have interest. You have financing on that. What piece of the interest? Utilities, maintenance, snow removal, repairs. Do all those costs fall into it? So it's just really an area that we need to be cognitive of. It is going to create, I think, some heartburn for some exempt organizations, because the tax law went into effect on January 1st of 2018. Sometimes you may be a March 31st year end, so you have 3 months of your fiscal tax year that we need to worry about. Or if you're a June 30, we have 6 months. And so what do you do as far as filing a 990T? Do you go ahead and pay a number in? Do we wait for guidance from the IRS? Do you make estimates? It's really an area that we're all struggling with because we don't have the true definition or the rules or the regulations to figure out what the computation is.
Let me run through a real simple example, and two of them. Charity A just buys in downtown Kansas City $100 a month. It pays for parking and lets the president of the charity park there. And so last year, the president did not have to report his taxable income. It was a tax-free fringe benefit. And the charity is a nonprofit, and a for-profit would deduct it, and a charity would just say it's part of expenses. And now in 2018, if they let the president not pay tax on it, if they say it's a tax-free fringe benefit of $100 a month, am I correctly understanding it that now the charity has to pay a 21% tax on it, that the $100 is considered UBI, and now the nonprofit corporation has to pay not just $100 for the parking space, but has to pay the IRS 21 bucks. Do I have that right?
You have that correct.
Okay. So now let's go to the example I think you were talking about was Olathe, where there's a medical facility and customers and employees can park there for free, and they don't charge customers. Is that going to be taxable income to the employees when the patients can park there just as simply as the employees?
So that's the complication is if typically when you tax an employee on a fringe benefit, it should be the fair market value of the benefit that you're providing. So if you go out to Olathe on a surface parking lot where no one's paying for parking, in theory, the fair market value is zero, therefore nothing has to be paid to the employee, or the employee doesn't have to pay tax on that. But then the question becomes, what about that surface lot? What's the cost of it?
Jeez.
Do we have to think about depreciation? Do we have to think about interest? Do we have to think about repairs? And then that's the piece that we need to start thinking about UBI. And I'll make it one step complicated is that if you go to a hospital, guess what? The parking lot's used by employees and it's also used by patients. So do we get to do an allocation of those costs into determining UBI? And when you increase your UBI, there will be no deductions that you can use to offset that income.
And on behalf of all of us here, I just want to say thank you for having that swamp drained, because now the laws are a lot fairer and more understandable. And obviously the people in Washington are thinking of New York, and we have $400 a month for parking there, and so as opposed to Kansas City or Olathe. But I grew up in Milwaukee, Wisconsin, and people complain about parking in Chicago or Washington, New York. I grew up in Milwaukee. It was miserable. I worked at a fire hydrant factory, and you couldn't park within a mile of the place. That was tough parking those days.
Thank you, Chris. I think we have one more slide left. Oh, I guess I'm done.
Want to read that? Want to read the disclaimer?
No, it's all right.
Well, with that, let's turn to the impact of changes on Changing with Donors and Corey Ziegler and of the Community Foundation. Oh, I think questions now are on what we've said so far, and then tell you what, when we have Corey talk, and then if you have any questions so far on what we've asked, come on down and or we'll handle them then. Corey.
Okay. Great, thank you, Chris. Just sitting here listening to Mike. We work with Mike at the Community Foundation, and we're just so grateful that his brain is thinking about all these issues because a lot of them are affecting us as well. This is just another example of tax law that's supposed to simplify things and doesn't. So thank you for your great brain on this. We thought it might be helpful to at least share a little bit from our perspective about what we are seeing in terms of charitable giving, at least with our donors. A lot of our donors are then supporting all of your organizations, and so we thought it might be helpful to share a bit about that. Before I do, I thought I'd just really quickly tell you what a donor advised fund is, because I'm not sure if everyone is familiar. Our work at the Community Foundation really is working for donors and helping them get connected with charities and providing support to charities on their own timeline, whatever works for them. And so we are primarily doing that through donor advised funds. We work with individuals and families and companies who are setting up funds where they make charitable donations into those funds whenever they might need to, and then they're using those funds to support charities on their timeline. And sometimes people are using funds to use in a year when they've had a large income event. Maybe they've sold a business, or they've had a lot of earnings that year that they want to set aside for charitable giving, but they're going to do the giving maybe the next year or the year after, and they wanted to have a place for those dollars. And that's what a donor advised fund primarily does, and how we work with most of our donors. So I thought I'd share just quickly, the end of last year, a lot of financial advisors and accountants and attorneys were talking with their clients because we had one of the biggest years we've ever had at the Community Foundation in kind of a different way. We had a 99% increase in donor advised funds opened last year. To give you a little perspective, we usually see maybe 150 to 175 new donor advised funds in a year. We saw 363 last year, with 182 of those opened in December alone. So our staff was putting up cots and staying at the office as long as they could to make sure we could service all those donors. But we saw an incredible increase at the end of the year. But what was interesting was that half of those funds were set up with less than $50,000. In fact, we don't even have a minimum to create a fund. You can come to us at any level of giving. But most of these new donors that we're working with are at the lower levels, which says to me that they were thinking about some of these itemized deduction issues. They might be setting aside dollars in 2017 they'll be using later. We'll see more of this as the year plays out, but we were very surprised at the volume that we saw at the end of the year, at the dollar amounts we saw. We did have a large increase in stock gifts, as you might imagine. At the time, the stock market was really high, and it's been a bit of a roller coaster since then, but we've definitely saw an increase in stock gifts, and I'm imagining that maybe you did as well. So what do we expect in 2018? Much of this is what you've heard from Chris already. We've got the expectation potentially that they will have fewer itemizers out there, that there may be less motivated to give in 2018 because of that charitable bequests might go down because the estate tax exemption has increased. But as you've heard from two of us already, really we don't anticipate a lot of this to affect most donors that we work with, because they are really giving because they care about you and your organization, your success, and your programs. And so we really don't anticipate, maybe we're a bit Pollyanna about this, but we are hopeful that our donors that we work with are going to continue to give to your organizations in the way that they already are, because they care about your mission and what you're doing. So again, tell your story, get connected with those donors as much as you can. One area, though, that we are being proactive with our donors that we work with and financial advisors and accountants and attorneys that we work with, is to talk about this idea of bunching gifts. And Chris has talked about this just a bit. You might have heard that terminology. You could have heard somebody calling it clumping and lumping, which I thought was a funny term. It sounds like bad mascara. But they are, or looping is another term that we've heard, but it's the idea that you might give more in one particular year to get over that standard deduction, and then not give potentially in the next year or two, and then start over again. And so what we're doing with donors is encouraging them to consider a donor advised fund in the sense that they would be able to take advantage of some tax benefits, but then they would also continue to support the charities they care about evenly throughout those next few years, even though they might not be giving new gifts. And there's an illustration that we'll show you here on the next slide that talks a little bit about this. If you have a married couple filing jointly, and let's say they just give $5,000 a year, and that's a lot of donors we work with. They're giving at that level. They're giving $5,000 to charity, but in 1 year they decide to pool together those donations and give $15,000 to charity that year. And this is year 1, you'll see on this chart. So they also have mortgage interest and state and property taxes that they are deducting as well, that you'll see on the chart, the blue and the green. But that gets them only to $18,000, and the standard deduction's $24,000. If they stopped at that point, they would just take the standard deduction this year. But by giving $15,000, they jump over that standard deduction, get up to $33,000 in deductions, and they take advantage of that itemized deduction in year 1. But they've now used all of their next 2 years in that first year in terms of their giving. So the next 2 years, we would anticipate they might just take the standard deduction, again with their mortgage and their state and local property taxes. But then in year 4, they'd do it again, and they would take the $15,000 in that year, the next couple of years not add new money, but all the while they're in the donor advised fund, they're still continuing to give that $5,000 a year to the charities that they want to support. So the charities, we hope, are not feeling the pain of the new taxes, but the donors are able to continue to give at the level they're used to. They just lump it into an earlier year. Of course, they have to have the means to do that in years 1 and years 4, but we're hopeful that this is a strategy that financial advisors are talking to their clients about and really looking at ways that they can maximize their deductions. Because in this illustration, they end up with an additional $18,000 of tax deductions over those 6 years.
Okay, let me just ask, Corey, this really helps when you have the mortgage interest. So if you had 10,000 state and local taxes and 10,000 of mortgage interest, you just need like $4,000 to itemize. But for a lot of your older donors who are in their 50s who have paid off the home mortgage, then they only have the 10,000 of taxes. So like if I took out the mortgage interest in that computation, and then they gave $15,000 to charity, and they got their $10,000 state and local tax deduction, yeah, they itemize, but the first 14,000 charitable gifts produce no tax savings. Do y'all see kind of what I'm saying? So that for those people who have paid off the home mortgage, the bunching is going to be really hard to get that tax benefit. So instead of doing it every 3 years, if you have the assets loaded up in that first year, give 6 years worth of gifts so that you can, because if you just did this scenario with no mortgage interest, it hardly pays for itself compared to the other strategy. So it all depends on the personal tax situation of your donors. But boy, if they can have 12,000 of mortgage interest, then they just need a little bit to go over in the donor advised fund. That bunching every 3rd year would be pretty helpful.
Yeah, it's going to be interesting to see how this plays out, because obviously we're just at the very beginning of this year. We had the big increase in donor advised funds at the end of 2017, but it'll be interesting to see the activity of those donors, how they use those funds for these next few years, if they're adding new or if they're just going to be using those for granting out to the charities and then starting over. It's all up in the air a bit, but to Chris's point, every donor is different. So that's when your relationships with your donors is critical, relationships with their professional advisors, their attorneys, accountants, financial advisors that are helping them make these decisions. That's what is really critical. Some other points about 2018. So we've been talking a bit about the folks who are at the lower levels of giving that might be considering the standard deduction or whether or not they can itemize in a particular year. But then you have the donors who definitely will itemize because they're at the higher levels of giving, perhaps, and they might even have big mortgages and state and local property taxes as well. But when we're talking about the giving, we do anticipate that there might be some incentive for those larger donors to continue to give and give even more. And there's a few reasons why. You'll see on the slide that the P's limitation, it was a limit that used to apply before this year, before 2018, to itemized deductions. And it says repealed, and I was being a little optimistic. It's been suspended for the next 10 years, but, well, 2026. I guess I shouldn't do my math, but it's hopefully not going to come back because it does affect many of us in the room, I'm sure. The limitation would cause folks who do itemize to have to basically take a haircut on that itemized deduction, reduce it by an amount that their adjusted gross income would exceed a certain threshold, and they have to reduce it by 3%. So it could be a significant barrier for giving if folks had that reduction in their itemized deductions. That's no longer the case for this year and for the next several years. So the full itemized deduction that they're available to take, they would get to take. They wouldn't have to take this little haircut at the top. They also have, as we all do, the ability to give cash and deduct up to 60% of their adjusted gross income rather than 50%. So that can help as well. We're hopeful that that means that they'll have some more dollars that they're putting into their charitable giving. On the corporate side, we've seen some interesting trends already this year. It's not just individuals that give, as you know. You've got companies that are supporting you as well, I'm sure. And we've seen more companies in this first quarter work with us on matching gift programs than we've seen in years. I think there's a couple reasons, I think, for that. They are seeing that many of their employees, especially younger generations, are wanting to give back to the community, and they expect their company to do the same. And this is a great way for companies to help their employees give and leverage those gifts by adding company dollars to the gifts. But younger employees especially, and now a lot of folks who may not be itemizing deductions anyway, may decide that they won't give, but this is an incentive to give, that they know, well, hey, if I give $100, my company's going to match that. I've just doubled the donation to this organization. So if you have relationships with companies, or even with your donors who work for companies, you might always ask the question, does your company match? More and more of them are, and we're working with a lot of them in the community, and it's great to see because they're investing in their employees in a way that maybe if employees didn't have the tax incentive to give now because of the tax law changes, this might be an incentive for them to give. We also hope, as Chris mentioned, the companies have lower tax rates now, that we hope that they are giving more back to the community. I think sometimes they're also doing things for their employees as well, but we're I'd say optimistic that companies will continue their giving trends and continue to give more. But I would echo everything that Chris mentioned about the IRA. We get a lot of donors who ask about that IRA rollover and encourage them directly to give directly to your organizations. As you mentioned, the Donor Advised Fund is not an eligible charity to receive the IRA charitable rollover, and so really our job is to then make sure that they are aware that they can give directly to your organizations when they are trying to potentially work through us. And so we like that law. I mean, I think it's a great opportunity for people to give in a tax efficient way. It would be great if they would allow it to go to donor advised funds, but I think it's working just fine now. Although I did hear that the organizations, one of our donors in fact, was working with one of the larger IRA companies, and the company just said, well, we're just going to send you the checks that are made out to the charities, but you have to now actually send them to the charities. They were not really doing much due diligence at all, and they were just basically writing the checks to the charities the donor asked for, but sending them back to the donor to then have to deliver to all the charities. It was an interesting conversation. So, someday it may be that the IRA companies no longer want to do that work, and maybe they'll help lobby to change the rules on it. But for now, that's how it is. And we encourage donors to definitely look at that as an option in their giving. So let's see, how much time do we have? 5 minutes. I'm going to very briefly touch on these last couple slides, only because it is an area of law that's a little bit in flux at the moment, and it happened at the end of the year, just like tax reform did. there was an IRS notice that came out that talks about donor advised funds in particular and some private foundation issues. And I just wanted to make you aware of a couple things that are in this notice that we've actually submitted comments to the IRS. They were due in March. I know Chris worked on some comments as well. A lot of community foundations and commercial gift funds were writing comments to Treasury about this notice. But there are a few issues addressed in there that might impact you, especially if you're receiving donations from donors who give through donor advised funds. Donors can pay pledges now out of their donor advised funds. You may not have felt this as much as an issue as we did, but we always had to ask the question, when a donor would ask us to make a grant to an organization, we'd have to say, well, did you personally make that pledge and is it binding? In other words, did the organization have a capital campaign, let's say, to build a building, and they relied on those pledges to go get financing to build that building? If so, that's really a personal obligation of the donor, because the charity could go back to the donor and say, hey, you promised to give us this money. We went to the bank to get a loan because of it. You've got to give us the money. If the donor came to us and said, well, we want you to send a grant from our donor advised fund to satisfy that pledge, technically under the old rules that would not have been allowed, because we'd be satisfying a personal obligation of the donor, and that's not something we can do. But now they've got some hoops that you have to jump through to make it work right, but basically we can pay donors' pledges out of the fund as long as we don't reference the word pledge. So when you get a grant check from us, from someone's donor advised fund, it might be related to a pledge, but it may not say that on there. We're hopeful that they maybe take that little piece out of the proposed regs. This notice is basically proposing some rule changes that they wanted everyone to comment on, and then they'll come up with the real rules. So we're hopeful that they take that little piece out so it's not a barrier.
And just an illustration, we sometimes have seniors who have a private foundation, they're in their late 80s, and they say, all right, I'm in for $1 million. And so the law for private foundations is a private foundation cannot satisfy a legally binding pledge of that senior citizen. It can pay a non-legally binding pledge. The good news for donor advised funds, they can pay either legally binding or non-legally binding. This is official IRS policy right now. So it's perfectly great to say, for a pledge drive, give from your donor advised funds, you have better law for donor advised funds than you have for private foundations.
The next piece on this that I think you might feel a little bit like we do, the rules around donor advised funds paying for a donor to attend an event that you might be holding have been a bit challenging, to say the least, and they still continue to be that way. But the bottom line is, when a donor comes to us asking to make a grant from their donor advised fund to come to your charitable event, that's your fundraising event, your auction, your golf tournament, we cannot pay any portion of a ticket or the table registration for them to attend your event. And I think that's the way the rule is going to stand. That's basically what they're proposing in this notice, and I think probably will stay that way. It'd be great if they would treat us the same as they do individuals. As you know, when you're holding your events, a lot of times you'll say, the ticket's $100, but $50 of that is deductible, and 50 just represents the cost of the dinner, let's say. If we could say, okay, that $100 ticket, 50 is deductible, we'll be able to make that grant out of our funds to the organization for you, and you pay your other 50 separately. If we could do that, that would simplify our world quite a bit, but as of right now, we can't. So if you are receiving a check from us and a check from an individual, and the individual is basically paying for the full value of their ticket, that's why that's happening. But we're not going to hold our breath that that's going to change, but we're hopeful. And then the last thing, this really probably won't be something that you have to worry about a whole lot, but I know we're interested to know, kind of in the audience, what you see out there. The notice also talks about donor advised fund grants going to charities, and whether the charity needs to treat that as a grant coming from us, the community foundation, which would be a public charity, 100% public support, or does it need to treat that as a grant coming from the individual donor who created the donor advised fund? It could be a big issue for smaller organizations in particular that are looking to calculate that public support test to make sure they stay a public charity. I know Chris was interested to see.
I'm going to be meeting with people. So a quick show of hands, a couple of things. First, when you receive a gift from an anonymous donor, and it's a large gift, let's say over $10,000, how often do you know who that person is? Where they just don't want to be anonymous. They want to be anonymous to the public, but they let you know. Just show of hands, how many people know who the anonymous donors are of gifts over 10,000? Now, for gifts over 10,000, how many often do you not know who the donor is, where it's truly anonymous? A minority, but it still happens. Okay. And for anonymous gifts, how many have anonymous gifts that's more than 5% of your revenue? Anybody? Okay. How many of you receive grants from donor advised funds? Just show it. All right, everybody. And how many receive grants where the donor advised funds are more than 5% of your revenue? Anybody? Okay, well, one. All right. Thank you very much. This is helpful as we go to the IRS to talk about these proposals and how they should play out. And finally, the private foundations wrap up. Just well.
Sure. No, we were also asked in this notice to comment on how we see private foundations using donor advised funds, and we see them as using them as a way to potentially make grants, but not necessarily as a way to avoid some of the private foundation rules. I know that some foundations nationally are seeing some issues there, and I think that's what the notice was trying to address. But from our perspective, we're happy to work with private foundations in any way that we can. So.
Very good. Well, let me turn this over here to Jeff.
Thank you. This concludes the expert portion of the panel. I just want to talk a little bit briefly. We've covered so much already, but a little bit about what our strategy is at UMKC and what may be the same for many of you. Go on to the next slide, Chris. We all know what the gift pyramid is. The most number of donors are our annual gifts and our major gifts, and then the pinnacle of our giving is planned giving, and what we ultimately work towards, because that's where the significant number of larger gifts come from to our charities. So what is the tax reform impact on annual giving? That we've talked about many things. The ones that are larger donors that are going to do this bunching, the good news is now we can say they're paying on commitments. Can we use that word? Pledges, commitments. We need to share that information with our donors. There's an opportunity for us to reach out and communicate with our donors and learn what they're hearing from their advisors, as well as let them know about some of these the changes and how they can continue to support the things that they really like, the things that they're volunteering for. We aren't seeing a whole lot of impact at all in annual giving. The numbers are steady at UMKC. In fact, we've bolstered up our annual giving program over the last 18 months, and so we're actually seeing increases, and so we don't really know what the effects will be on this, and it probably will be not even this year, but next year in 2019 before we'll really see what those impacts are, what the changes might be. On the major gift side, we always ask, or it's another reason to talk to your donors. It's a stewardship opportunity. Have you asked your financial or tax advisor what those impacts might be on you personally? And if you have, are you going to be making any changes to your estate plans? Are you going to be making any changes to how you contribute annually? Have you established a donor advised fund? And how are you planning to administer that? These are questions that you should be asking your donors, and then that will, if they don't know the answer to that, they will be then wanting to consult their advisors. Those conversations always about giving and that you're thinking about them and how it impacts them is always helpful to you and your organization. So we would encourage anything that you can come up with to talk about reasons for them to interact with their advisors for that. And then in the planned giving side, we've talked about the IRA rollover. Chris and I are crafting a letter to our friends and alumni that we know are over the age of 68 about utilizing this opportunity when it comes available to them, or if it's already available to them, and just making sure they understand that it's an advantage and that's the place they want to give first before they start writing checks from other accounts. And again, I already mentioned it, but asking questions about have they altered or changed their trusts or their plans with their estates as a result of any of the tax law changes. We encourage our development team to interact with our planned gift donors all the time about changes that may be occurring, et cetera, but this is another excuse to make that call. So we hope that we'll get some good results from I know the letter will be well written because Chris will probably write all of it, and I'll put my signature at the bottom. There is one area, though, that's being impacted in the university, and not as much at UMKC, but at some other larger universities where parking preferences and privilege for seating and preferred seating, where you pay a certain amount to sit in a certain section or park in a certain area, and that is, with that not being deductible anymore, what some universities are doing are raising the price of the tickets to absorb that, or the cost that you would pay to, used to be a donation to park in a place, is no longer going to be tax deductible. Again, we won't know until basketball and football season go through a couple of cycles before we know what the impact will be on that. But so far at UMKC, we've had steady to small increases in our renewal of athletic tickets, and the preferred seating area has not been affected even though we've made this change. So the revenue's the same, we've just changed how it will come in. So in summary, basically, work with your volunteers and listen to them and ask them lots of questions. Tell them to ask their advisors questions. I've said that 3 or 4 times. It's all about stewardship. And every time there's a change in law or a change in leadership at your organization, or when the tax codes do something strange, that's a great reason for us to call people and interact with them. And so we're always looking for a reason to get in the door and talk to people, right? So that's, we got a gift from the government to go and do our job. So we're in a waiting period. You know, people won't file their 2018 taxes until April of next year, and then we'll see what those results are. And it may not be until midsummer of 2019 before people realize that they might need to make some changes in how they give their gifts that might be affected by all this. And by that time, as Chris said, we might have new people in charge, and the law might be different by then. So be patient, listen, ask lots of questions.
Oh yeah, very good. Well, thank you. We are now at a good point. If you have any questions, we're here. And also, we will stay afterwards if you have a kind of a personal question and the like. But that's kind of our big picture is the tax laws have changed for 20 million donors who used to get tax savings from the charitable gifts, and now they're not going to. Will they change their giving? I think time will tell. But for the most part, I think your large donors will be loyal to you. It might be some of those little smaller annual gifts that you find the revenue decreases. And I think the big shock will be when people fill out their 2018 returns in 2019. If you're like me, I used to save receipts for all the household items that gave to Goodwill and other charities. I don't have to do that anymore. And you might not have to do it anymore because you won't be able to itemize in 2018. So will they cut back their giving in 2019 when they discover, oh, I can't deduct all these gifts I gave in 2018? But for the educated donors, they're probably acting right now. Other question I had, how many of you receive gifts from IRAs, charitable gifts from IRAs? Okay. How many of you have noticed that your giving has increased in 2018? Okay, a fair number, that you have knowledgeable donors who realize that that's the way to do it. So this is really helpful when we learn from each other. Any questions?
We have one up here, Chris.
Oh, okay.
I have 2 questions. What, if any, impact on tax credit programs is there with the tax reform law? And also, are donors who utilize the IRA rollover for charitable giving also eligible to take a tax credit if they're an eligible tax credit donor?
Are you talking about the Missouri tax credits?
Both state and federal. So if they give for LIHTC credits or if they give for state reduction in tax credits, are they still more likely to give for a tax credit? And then are they eligible to utilize that if they give from their IRA?
Okay.
My mic's been shut off.
I haven't spent a lot of time on the credit piece of it. I don't think it's going to affect the, I guess, the overall use of state credits. I do think you're going to have to be careful about awarding credits for contributions from IRAs and then the use of that, because in theory, the person is not paying income on the IRA, nor are they taking a tax deduction. So you may want to be careful on, if you do have tax credits and you're awarding those tax credits, you may want to limit those just to cash. That would be something we would just have to look into. But I don't see otherwise that it's going to have an effect on the credits.
Yes, I'd like to get back to the parking and UB TI. If your landlord charges you the same monthly lease and it includes parking, say up to 25 employees, and they don't break out what's the value of parking versus the cost per square foot, what is your responsibility to try to determine that information from your landlord?
So another very complicated factor, that essentially if you're leasing a building and it includes 25 spaces for parking, the question is, of the rent that you're paying, what's attributable to the parking? So hopefully the IRS will give us some reasonable basis to think about that calculation. It could go back to what is the true fair market value of other parking in the area. But I think some piece of that rent should be attributable to parking, and therefore, unfortunately, unrelated business income, unless you decide to perhaps tax your employee on that benefit.
That's what happened at UMKC was, I gave the example, we pay $100 for a parking lot, and so now we have to pay a $21 tax, but if we put the $100 in the employee's income on their W-2 form, then there is no $21 tax on the charity. And so that will require you to pay payroll tax. That is, when you have an employee, you got to pay 7.65%, and then the employee pays 7.65%. And so that if we put the $100 in their tax return, I got to withhold on the $100. I got to pay the payroll tax. But for the charity, paying 7.65% is less than paying 21%. The real challenge you have is that what the value is. You have a fascinating study of how do you know what the value is of the rent you pay for your 21 employees. So, but that's the other option, and UMKC decided just to have 7.65% paid rather than 21%. We're told that we have to include the value of our parking, though I pay through the nose. It's a revenue raiser for UMKC. We don't have a parking license. We have a hunting license. At least that's what, or fishing license. If you ever parked at UMKC. Okay. All right.
Okay, we have another up here.
What about an IRA that is inherited? Is the value in the IRA a part of the $11 million
If
underneath that limit?
Yes, so if I died, my dad had a $10 million IRA, and now I die, that's part of my wealth. I'd have to pay a state tax on that. If for the beneficiary, they'll have to say that that's their asset when they die.
But
What's
would
left
it be
of
to someone's advantage to plan a planned gift out of an IRA remainder so that it would be less taxable to the heirs?
Absolutely. So that if I have a client or I have a donor who says, I have $100,000 in a checking account, I have $100,000 in a retirement plan account, I want to give half to my kids, half to the charity, it is a no-brainer. Give the pre-tax dollars in the retirement plan account to the charity and give the cash to the kids. And so as you're planning charitable bequests, a couple things. First, never use the word bequest. Donors don't like that. They don't like to leave a legacy. They don't like that kind of stuff. They don't want to think about dying. but just say, you know, a lot of people when they draft their wills have something go to charity, then that's the most likely way to get the gift. But then, yes, structure it to come from those assets and leave the tax-free stuff to go to the children. Yeah, if you know that your child's going to have $11 million, and we'll see what the threshold is later, yeah, leave that to charity is kind of my knee-jerk reaction, because you pay both estate tax and income tax in the IRA, as opposed to just paying a 40% estate tax on those other assets.
Right.
Anything else? And we'll hang around later, but one thing I've learned from being a teacher is that students and people at programs like this are the only class of consumers who want to get a little bit less than they paid for. But, oh, here, we have a question here.
Have there been any changes in the area of non-cash contributions, like gifts of artwork, appreciated property, or gifts in kind?
Those have not changed. The cash gifts went up to 60%, but the gifts of appreciated property are the same. The one thing that changes in the calculation is the tax rates have gone down, and so the tax savings have gone down, from 39.6% to 37%. But yeah, the 30% limit on gifts of appreciated property, and how artwork has to be used by the museum for its exempt purpose, all those rules are the same. Oh, there's another question. Go ahead. I got you.
Would Nonprofit Connect or you experts be able to provide some kind of white paper standard examples for us to use with our nonprofits to explain all this to our donors?
Yes, the good people at Nonprofit Connect have committed to doing that next week. I don't know. There probably is something out there in simple language that we can kind of borrow somewhere, I'm sure. Okay, Dana, great.
Well, before we wrap up, we will have more resources on both NP Connect and ArtsKC's website, both video as well as a lot of valuable links. We will be sending this PowerPoint out to everyone via email following this event. So I hope that all helps. So thank you for coming out on this beautiful Wednesday afternoon. And please join me in thanking Corey, Jeff, Mike, and Chris. They'll hang around for a little while, so if you have more questions, you can come on down.